Okay.
The broadcast is now starting. All attendees are in listen-only mode.
Good morning, everybody. Welcome to our Monday weekly Singapore Market and Equities Outlook. I'm Joshua Tan, Head of Research, and I will take you through the STI Market Outlook for the week, and then we'll move on to an update on equities and a feature on Capital Land, which is done by Brian Goh, our property analyst. Okay, last Monday we said we expected a positive bounce, but the 200 daily moving average to act as resistance. Okay, that was for both the S&P and the STI, but I have the STI chart here. Okay, so we had that bounce, and I said the 200 daily moving average would be a bit of a resistance. That was the case for 2 days, and then in our morning commentary on Thursday, we actually turned more bullish and said we expected the 200 daily moving average to be busted, and that did happen. Okay, and so we had 2 positive days for Thursday and Friday. One of the points we want to make is that please read our morning commentary every day in the morning note. It's one of the very few trading directional commentaries in the market. Okay, so this is the morning note on Thursday, which said equity trading signals are looking bullish again. Okay, and there was a whole host of reasons. Basically, the intermarket picture turned a lot brighter, and we stated there that the STI had a good chance of busting through the 200 daily moving average. Oops, sorry. Hit the wrong key. Okay, so what now? Momentum is positive. Okay, so today we have started bright, and we're actually somewhere around the 3,000 mark. Okay, but we note that this is a very messy resistance region, so I don't think it'll go clean through. The S&P 500 is also hitting a resistance region. So markets are currently staying optimistic, okay, following the correction, which is over here. And we had that positive shift of tone from Washington regarding a compromise on the fiscal cliff, and that's why we had the rebound. But the S&P, just like the STI, is heading towards a resistance. Okay, so it might not, it will probably have some gyrations at that point. Okay. The lack of detail so far on the fiscal cliff could be a potential negative. Okay, so the short-term trend and momentum is still positive. Okay, but we are very close to the resistance lines now, so I think a bit of caution now is warranted. Will we get any impetus from the fundamentals? Macroeconomic data is still regarded as weak, but we note the following positives. The rate of slowdown in Asia is easing. China's economy is actually showing signs of bottoming. We released a report on this on Friday, so you can go through that. U.S. macro data is mixed. Housing is doing very well. Consumption is doing okay, but it's more of a dip into savings. Has helped it quite a bit. New capex orders is still pretty poor. However, we note that that positive news in the fiscal cliff could easily revive capex orders dramatically. On the fiscal cliff resolution, the positive is that the U.S. presidential elections outcome is seen as a defeat of extreme right-wing Tea Party elements of the Republican Party. So we're seeing a return of the party to more of the center, and that means they would probably be more receptive to tax increases. SCI earnings for the third quarter was actually in line, which is actually also a positive. And markets, we think, may start to look past the bad for what we think could be a positive first half next year, so long as the fiscal cliff gets resolved. Okay, for the week ahead, new capex orders come out on Tuesday. Markets don't really expect a good number, and neither do we, as the fiscal cliff is not yet resolved, and that is the chief reason why investment has been performing poorly. Industrial production for Singapore comes out today, and we actually expect that the rate of contraction for the 12-month moving average year on year to continue its trajectory into more positive territory. Okay, so short-term trading directions aside, please note that the overall trend for equities is still largely higher. Okay, with previous technical damage in the second half of last year largely repaired. So the S&P, as you look at the long-term trend, is going up. MSCI Southeast Asia, the long-term trend is still up. The Hang Seng had huge damage, but largely repaired, going higher. And the STI also had its damage in the second half of last year, more or less, on the verge of being repaired fully. Okay, our SG, Singapore equity strategist Derek Heng, his views on what could outperform stays the same. He has CapitaLand on the list, SATS, and SIAEC. He went through these in last week's webinar, and he featured SIAEC in detail. So you can go back to last week's webinar to check out SIAEC. Next week he'll talk about SATS, but this week Brian Goh will talk about CapitaLand, which he covers. Okay, so I'll pass it over to Brian right now. Thanks.
Hi, good morning, trading reps. Before I start on the detail of CapitaLand, I will go through some of the news flow for stocks under our coverage over the past week. First, we have Genting Singapore, where its subsidiary submitted a top bid for a hotel site at Jurong Town Hall Road, with a bid of 238.2 million. And the top bid is 16% higher than the second bid, which is a seasoned hotel and operator and landlord manager. And the bid, from the opinion of our analyst, Magdalene, the bid was excessive relative to the bidders in the same tender and also against the winning bids of previous tenders from the government land sales program. And the reason perhaps the reason for Genting to bid so high, it's because they want to have a strategic move for their existing Resort World Sentosa, where they can cater to a different tier, the lower tier of their patrons, where they can provide accommodation for their patrons from Malaysia. It serve as an alternative accommodation for them at the Jurong area. And in terms of earnings, our view is that the development is not expected to be significant, the contribution. So we maintain our neutral rating with fair value of $1.15. Next, we have news flow related to OUE, where the TCC extended the closure date of its offer of $8.88 to FNN to December 11th. So that means TCC could be buying times to consider about its offer and to examine the detail of OUE's offer document, which should be out no later than 6 December. Or technically, it should be between November 29 to 6 December. So the detailed document of OUE offer document will be out. And with that, we already downgraded our recommendation last week to neutral for its attempt to beat FNN at the current moment, as at this juncture, we still, I think there's too much uncertainty to the eventual costs to to beat FNN. So we downgraded our recommendation to neutral. And next, I will go into detail on CapitaLand. This is a brief overview of CapitaLand. Mainly, they are the so-called very diversified property developers. Key exposure, as shown by this assets by geographical location, about slightly more than 1/3 in China, 38%, slightly less than 1/3 in Singapore, 32%, and the third largest country is Australia. Pretty well diversified into these three core countries. And in terms of business segment, they are in residential in Singapore, in China, and they are in commercial, where they have the underlying REITs, capital, commercial trusts, and etc. And they are also one of the largest service residence operator. They are pretty strong in retail as well, where the underlying subsidiaries and REITs are like Capital Malls Asia, Capital Malls Trust, and CRCT, etc. And in terms of Australia, it's operated through the Australand. And for our current view on China, we are pretty optimistic about China market in terms of possibly bottoming out and may stage for recovery. So with that, we look into the assets diversification of CapitaLand in terms of in China. Mainly, they are into about 1/3, slightly less than 1/3 in residential, 32%, and 35% in retail, and the rest, the third largest segment is mixed and commercial development, which is 22%. So we can see that their assets in China are pretty diversified as well, not purely in resi or not purely in retail. And in terms of investment merits, other than diversified, we also like their capability in originating REITs and property funds. So over the past decades, they have originated the REITs as shown in this table, and it's proven track record that they can raise capital from the capital market through the REITs and property fund. So this is one of their strategy to play this capital recycling model and keep their asset light strategy. And number two is the potential assets in their portfolio, where we identified a few. This table here shown the assets which is potential to be listed or divested over the next 2 to 3 years through either sell it to the third party or list it to the REITs. So the mostly we can see Raffles City in China. They have 9 Raffles City developments in China, total 9 Raffles City developments, 1 in Singapore, 7 in China, and 1 in Bahrain. So with this 7 portfolio in China, we think it's pretty feasible for them to form another REIT for Raffles City. And it could be listed in Hong Kong, Singapore, or in terms of dual currency, that kind of REITs, or maybe in futures 2 to 3 times when the China market is ready for REITs, and this could be a potential exit point for them as well. Other than Raffles City, there are other completed assets like Ion Orchard. It's held through CMA. And also completed one is Queens Bay Mall in Malaysia, Penang, which these are the potential assets for them to diversify, to divest. So when divest, they could realize the value of these assets and then recycle into other good investment. And number 3 investment merits that we like them is their service residence. They are the world's largest service residence owner and operator. So in terms of hospitality market, most of the markets are performing well in the Asia, with year-on-year higher growth in terms of RevPAR. And also over in Europe, we see that the Paris and London, these two key markets, are performing pretty well, outperforming the rest of the Europe market. So this Paris and London also, they are two of their key exposure in Europe, two key exposure market. And in terms of the apartment growth by apartment units under management, by 2012 first quarter, their apartments units under management is about 30,000, and their target is to grow the units under management to 40,000 by 2015. And in China alone, they are targeting 12,000 compared to their current 8,000 units. So they are targeting to grow in China the service residents to 12,000 by 2015. So the good point for service residents is the growth can be from in terms of equity investment, they own the asset, or they can grow through the management contract where they manage the hotel, the service apartment owned by other landlord, but they are the manager, so they can earn management fee. So it's one of the good point about this business model. And fourth, it's about China recovering. So in terms of residential sales, we have since 2Q of this year, we have seen in terms of unit sales and also sales value has improved. So year on year for the 9 months, residential units have grown 61% and sales value grown 75%. So it's already shown sign of recovery in China. And other investment merits is they are still holding strong cash of 5.4 billion after the aggressive investment last year and this year. And just to remind investor that this year to date they have invested about 3 billion, but still lesser than the last year total investment, which is about 11 billion. And they are still, according to management, they are still remains in investment mode. So they will still look out for good investment. And also underlying REITs currently are performing well, which we believe that this would be a good time for the REITs to buy more assets because their share value is higher now. They have higher capacity to raise money to acquire. So this means higher chances that the capital land, they can sell some of their matured stabilized assets. And some of the key risks that we wish to highlight is the policy risk in China and Singapore residential market remains, and downward revaluation or impairment in economy downturn, which this point is pretty unlikely this year. So we still expect higher year-on-year revaluation. And currently, our target price is $3.55. Back to this 15% discount to RNAV. And that's at the target price representing 0.98 times to the forward book value per share. And with that, we thank you for your attention this morning, and we will open the floor to question Q&A. Any question you can key it in the webinar panel there, where you can type in your question and send it to us, or you can come down physically to level 6 presentation room. We are here to answer your question, and also we are serving coffee and tea over here, so you can come here to have a chat with us. Okay, thank you very much.